Business Finance Chapter 11. In Chapter 10, we talked about information from the capital market history, and we looked at historic returns and variances and standard deviations of those returns to look at the average risk from the historic marketplace. In Chapter 11, we're going to look at using that information to make projections about future risk for investing in the market. So when we start talking about risk, we're talking about the risk on our returns. So our expected returns from any investment are based on the probabilities of all of the possible incomes. So expected returns in this formula, the ER equals the sum of all of our probabilities occurring times the expected return on an asset. We're going to look at this in relation to individual assets and portfolio mixed of assets. So we have two examples of stocks here. So we have stock A and stock B. We have the various expected returns of stock A and stock B during a neutral economic period, during a recession, and during a boom economy, and the probability of each one of those events occurring. So you can see that stock A and stock B are equal for an expected return of 15% in a neutral economy, but during a recession, stock A expects a 20% decline and stock B expects a 30% growth in a recession. The opposite is true for a boom economy, where stock A expects a 35% increase and stock B is a 10% decline. We then have the probability of each one of those events happening. So a 25% probability of a recession, a 25% probability of a boom economy, and a 50% that it would remain neutral. So when we extend those out using our equation for expected returns by taking the expected return times the probability of it happening, we then get an average return for that stock, taking into account all of those probabilities could happen. So let's just look at stock A here, where we have in a recession, we have a 25% chance that this stock would, during a recession, have a loss of 20%. So if we take the negative 20% loss times that 25% chance or probability, we get negative 5.0. Our neutral economy has a 50% chance of occurring, and if that occurs, we have an expected return of 15% for stock A. So we take 15% times 0.5, our probability, we get 7.5%. And in a boom economy that has a 25% probability of occurring, stock A would grow by 35%. We take 25% times 35% and we get 8.8%. We add those three numbers together and we get an expected return on stock A, taking into account all probabilities of different returns, of 11.25%. The variance and the standard deviation, if we remember from Chapter 10, measure the volatility of our returns. So the variance is the weighted average of our squared deviations, and the standard deviation is the square root of our variance. So when we're looking at then, we extend out our probabilities looking at the deviance between them, so we get our variance and the standard deviation for our expected returns. So for stock A and stock B, looking at the probability of each one of those occurring. A portfolio, before we were just talking about individual stocks and the different probabilities of various risk for individual stocks. Well, we're also going to discuss portfolios. And a portfolio is a collection of assets. And the risk and return of a portfolio depend on the combination of our assets. So what is the expected return of the portfolio and the standard deviation? It's similar as our individual assets, but we look at it as calculating out what is the risk associated with each asset, and then what percentage is the portfolio invested in each asset based on that kind of risk. So we're going to look at portfolio expected returns. So for portfolio expected returns, the expected return of a portfolio is the weighted average of the expected returns for each asset in the portfolio, weighted by the percentage of the portfolio invested in each asset. So let's look at a portfolio that has 5 different stocks or assets that it's invested in. The dollar amounts equal the total dollars invested equal 100% of the portfolio. So when we're looking for the weight, it's the investment in each individual stock divided by the total investment within the portfolio. We then take the weight of each asset times the expected return of each asset, and that gets a weighted expected return of the asset. So when we add those weighted returns together, we get the portfolio return. So this portfolio return has a 10% expected return based on the individual expected returns of its assets and the portion or percentage that we've invested in each one of the assets within the portfolio. We can also calculate this, as we can see in our Excel file, that we're looking at the different stocks versus our portfolio. So the steps in this calculation are that, one, we calculate the expected portfolio return for each of our stocks and each of our potential risk. So we have our recession risk, our neutral risk, and the boom economy risk, the probabilities of each one of those occurring. We then apply the probabilities of each one of those situations to the expected return of the portfolio and sum the results. So here we have we have a recession with the probability of 25%, and then we have how each stock is expected to react to a recession, and the weight on them and how that affects the portfolio as a whole. You can see that either method gets the same exact expected return on the portfolio of 10%. Portfolio standard deviation is not a weighted average of the standard deviation of the components of the security's risk. If it were, there would be no benefit to diversification. So when we calculated standard deviation in Chapter 10, that calculation is different than how we're going to look at it in Chapter 11, because we can't look at just an average for our information, because it's not just a weighted average of our standard deviation. That will not equate to our portfolio standard deviation. So let's calculate what the standard deviation actually is for this portfolio. We're going to compute the overall expected portfolio return using the same formula as for an individual asset. And then we're going to compute the portfolio variance and standard deviation using the same formulas as we did for an individual asset in Chapter 10. So we have here, we calculate our expected portfolio return for each profitability or probability for the different 3 states of an economy. And then we calculate the deviation of our expected portfolio return from the total expected portfolio return. So we can see here our total expected return is 10%. The expected return in a recession is -3%. So when we look at the difference, we get a deviation of -13%. We then square the deviations found in step 2, multiply our squared deviations times the probability of each economic state occurring, and the sum of the results from step 4 gives us our portfolio variance. The other things that can affect a portfolio's returns, or even the return on an individual asset, are information that comes out about the company. So remember in chapter 10, we talked about efficient markets. So efficient markets result from investors trading on unexpected news. So with an efficient market, we believe that all of the relevant information of a company is publicly available, and it's that publicly available information that sets the prices of their stocks. So when a company makes an announcement or there's news about a company, that's it can be either expected, meaning we had an idea the company was going to predict this news, or it can be a surprise. The surprise, the expected components do not affect stock prices, but the surprise components do, whether they are good surprises or bad surprises. Efficient markets involve random price changes because we cannot predict those surprises. So we've talked a little bit in class during our current event times about how some of those surprise components can happen, such as Elon Musk tweeting about Dogecoin at 3 a.m. then had an effect on the price of Dogecoin. So we're going to talk about two different kinds of risk. So the first type of risk with investing is systematic risk. This is a risk that affects a large number of assets. It's also sometimes called non-diversifiable risk. So you've heard that we can lower the amount of risk that we take on by diversifying our investments. Well, systematic risk cannot be diversified against. It's sometimes also called market risk. So the examples of systematic risk would be changes in interest rate, changes in inflation, if the gross domestic product amount was less or more than it was projected to be, if we have foreign conflicts, things like the Ever Given getting stuck in the Suez Canal for a week, those things are large risks that affect the entire, can affect economies of more than just one company and more than one country, and that is where it's systematic risk. The other major kind of risk that we talk about is unsystematic risk. This is the risk that we can diversify against. This is the risk that happens for a particular company. It's caused by labor strikes, bad news, good news, new product launches, their CEO tweeting at 3 a.m. But the changes in that stock price would affect that company. So a surprise announcement that would just affect that company's stock. The reason that we can diversify against this risk is because it's an asset-specific risk in that it only relates to the individual stock that the announcement or change is being made about. When we're looking at our total return, the total return on a stock equals the expected return. So what we spent the first part of the chapter talking about and calculating in the previous slides, plus the unexpected return. The unexpected return is a combination of the systematic portion of risk and the unsystematic portion of risk. So that's the risk that market risk that we can't diversify for, and then asset risk that we can diversify for.